Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm sitting down with Gabriel from Neuberger, Berman to talk about what's happening in the private equity markets. Gabriel, it's great to see you again. Thanks for sitting down with Livewire today.
Thanks for having me, Chris.
Of course. The case for PE, Gabriel, has typically always been higher returns and less volatility. We've seen in the US in the last couple of years 20% plus returns on the S&P 500 with relatively low volatility as well, whilst private equity has also been slowing due to rising rates, geopolitical uncertainty and a decline in deal making. So does the case still stack up?
Well, the short answer is yes,
Yep.
Absolutely, right? I think, there's no doubt that public markets have performed strongly in recent years, right? But if you really sort of peel back the onion and dissect it, it's really driven by, a smaller number of stocks, right? So there is that concentration effect there, right? Whereas for private equity, if we, take a longer term horizon, we look at 5, 10, 15, 20-year returns, that asset class has consistently outperformed public markets, right? So, I think for an investor that's looking for more diversification, right, and premium returns, right, of course it comes with, additional risks, illiquidity, right, et cetera. But I think the private equity asset class, we strongly believe still has a role to play, right, in an investor's overall portfolio construction, in addition to public markets.
Yeah. Gabriel, another thing that I've noticed is that more and more capital seems to be flowing towards private markets and private equity. So more capital competing for the same or less deals. Is that something that you've experienced? How you're navigating it? And do you have to now consider deals that perhaps you wouldn't have considered 4 or 5 years ago?
Yeah, I would say the overarching comment is that the private markets continue to grow well. If we look at the charts, right, there's a chart that we always look at, right, the number of public companies in the US vis-a-vis the private equity-owned companies. I think both graphs are moving in opposite directions, right? The number of public companies coming down over the last 20 years and private equity-owned companies steadily ticking up, right? And of course, private companies are also getting larger. So the opportunity set to put a larger equity check to work is certainly there, right? As opposed to, are we looking at deals that we did not have to look at, 4 to 5 years ago? I said, no, right? I think if so, the bar is even higher now, right? Just in a greater sort of volatility market, in a market where there is geopolitical, uncertainty and softer economic environments, I think our selectivity has gotten higher, right? I think the good news is, at least from our perspective at Neuberger, is that the deal flow has crept up, right? It has kind of got more robust as we continue to grow our GP networks and continue to be proactive providers of solution to both our GP partners, as well as, the market opportunities that we see out there. So yeah, I would say that, we've certainly seen, more robust deal flow, and that helps the overall sourcing funnel and selectivity on our end.
Gabriel, just to follow up there, if I may, you talked about there being a higher bar. How does that manifest?
The bar has always been high, but in an environment where rates are higher for potentially longer, right, and there are multiple other factors to consider, tariffs, right, geopolitical tension, right, I think that stress testing on that base case becomes even more, I would say, stringent, right? So laser focus on operating performance, right? We absolutely need to have conviction that there's ability to grow revenues and profits, right? Because the ability to depend on, multiple expansion, on a sort of financial leverage, I think those factors have gone away, right? We've never really underwritten a multiple expansion anyways, right? It's always same multiples going in and exiting, right? But I think the other skill-based factors like, the ability for the sponsors and our GP partners to grow revenues and profits become even more important in today's environment.
Gabriel, where are you finding the most compelling opportunities at the moment? It hasn't changed since we spoke 6 months ago.
Yeah, I would say that, taking a step back, right? I think in an environment where liquidity is constrained, right, providers of patient capital like ourselves, I think we are well positioned to uncover some of these interesting investment opportunities, right? There's many, but if I were to distill it, down to the things that have been keeping us busy for the last few years, I think number one, co-investments, right? The ability to be a co-underwriting partner, to be a partner of scale and sophistication to our GP partners has been much appreciated, as a form of value add, and that has given us, the ability to step up and partner with our GPs on these transactions. Mid-life co-investments, a term that we've coined internally, right? Essentially us investing into a portfolio company that a GP has owned for a number of years, right? And our capital is utilized to provide a solution, right? It could be a partial recap, right, to allow the GP to send some distributions back to its LP. It could also be used for very strategic, transformative M&A, right, to realize the synergies from a combination of two different companies and ultimately position the asset better for a sale down the road, right? So that's on the co-investment side. And on the secondaries front, GP-led continuation funds have been a big theme, right? We see more and more of that happening, right? It's really evolved, right, this whole asset class. And today it really revolves around the top performing assets within the GP's fund. So, we are once again, a provider of liquidity solutions, right, to the older LPs of the selling fund, right, and capitalizing a new vehicle to continue to own these high-performing assets for anywhere between 3 to 5 years, right, and structuring these deals appropriately, right, from an alignment perspective to ensure that there's a good path towards a good outcome, right, for the secondary investors, including us.
Gabriel, let's talk about private equity access. As an asset class, private equity is becoming more accessible, of course, via semi-liquid evergreen structures. What do investors need to know as they consider these investments?
Yeah, I think we've been encouraged by the growth in that part of the market, right? It's still fairly nascent, right? And I think the whole semi-liquid evergreen sort of structure really helps to solve a lot of the pain points that have previously prevented individual investors or small investors from accessing what we believe is an attractive asset class, right? But at the same time, I think education, right, getting up to speed is super important, right? Because there's so many different funds and structures out there. It's important for an investor to know what he's getting into, right? What is the underlying strategy of this evergreen fund, right? What parts of the private equity segment is this fund going to be investing into? Who's the manager? Right? Do they have a track record? Right? Are they able to have the infrastructure to manage a large number of investors? Provide the reporting, the communications. So there's a lot of factors to be considered, but I think we're just scratching the surface there, right? I think there's a lot more to grow in that space, and we feel encouraged by the interest that we see to date.
Gabriel, it's always a pleasure having a chat. Thanks for sitting down with Livewire.
Thanks for having me, Chris.
If you enjoyed that video as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.